The matching principle. What is the matching principle? Well, first, it involves expenses. Expenses are a decrease in resources resulting from the sale of goods or provision of services. For example, providing payment to your employees for their work or providing payment to another company for office supplies. The matching principle requires these expenses to be recorded in the same period when they are incurred to generate revenue. So let's do an example. Suppose that on the 1st of January, a company purchases 12 months of rent. This would involve increasing the asset account of prepaid rent to reflect the amount of rent bought and decrease the cash account for the same amount. Now, suppose further that the company prepares financial statements at the end of January. As of the 31st of January, the company has consumed 1 month's worth of rent. But because the accounting system does not yet reflect this expense, we need to adjust the journal entry. This would involve increasing the rent expense account by the amount consumed during the month and decrease the asset account of prepaid rent by the same amount. This is known as deferred expense. A deferred expense is when cash is paid before they incur the expense. When a company incurs expenses and pays for them later, it is known as an accrued expense. This is very common with employee wages and interest. To illustrate an accrued expense, suppose that a company's weekly payroll is paid every Saturday for the work the employees have provided to the end of Friday. Also suppose the end of the period is the 31st of March, which is a Friday. Because the accrual basis requires that expenses be recorded in the period in which they are incurred, the company must record the expense on the 31st of March. This involves increasing the salaries expense account for the amount of salaries incurred for the week and to increase the salaries payable account for the same since it owes the employees those salaries. Now, on the 1st of April, when the payment is made, we need to adjust the journal entry. This involves decreasing the cash account for the salaries paid to employees and to decrease the salaries payable account by the same amount. So when is the matching principle used? It is used in adjusting entries as it is accrual-based, which has been proven in the previous examples. It is also used when reporting in the income statement, which is a financial statement that uses revenues and expenses to calculate the company's net profit or loss.
Thank you for watching.